All right, welcome to Talking Investing. I am Tom, and as always, this is not financial advice. Today, I want to talk about the Fed rate hike, the market's reaction to the Fed rate hike, and I want to talk about YouTube's reaction and retail investors' reaction as well. And then I want to go through and compare some numbers and tell you guys what I think is going on. So far, we've had a lot of downward pressure since the Fed meeting yesterday. I have a little bit of a different opinion than most people, so I want to go through that and talk about it. So if you're new to the channel, please remember to subscribe and hit the notification bell. Also, if everybody could smash the like button, I appreciate it. For those of you who are interested, you can subscribe to the channel and become a member by hitting the join button. We do a members only live stream each week, and we do some members only content, so we'd love to have you there. So the first thing is, let's look at the facts. The market closed red yesterday. It was green all day, and then it kind of roller coastered at the end of the day and finished pretty deep into the red. Well, we're a good bit of the way through the trading day today, and it seems like the markets are very red again today. So the S&P 500 is down 0.67 at this point. And this is the middle of the trading day, so I don't know where we're going to end. The Dow is down 0.15, so that's fairly stable. That is the one that I look at the least by far. The NASDAQ is down 1.34%, and the Russell 2000 is down 2.17%. If you're a retail investor like me and like most YouTubers, it's the NASDAQ and the Russell 2000 that probably more accurately reflect how your portfolio is doing. We see the markets had a very negative reaction to what the Fed did yesterday. So to summarize, the Fed raised rates 75 basis points. Everybody expected that. 100% of the market futures had priced in at least a 75 basis point rate hike. So I don't think anybody can say that was a surprise, and I really don't think anybody did say that was a surprise. There was some underlying data that I think was disturbing people, and what Jerome Powell had to say was disturbing people. But I want to show you some clips from Jerome Powell 3 weeks ago in Jackson Hole, and I think you're going to see what he said yesterday is basically the exact same thing that he has been saying. It's the exact same thing that I expected him to say. I also think basically it's what the market thought was going to happen, but for whatever reason, when they actually see it in print and they hear it, there's this knee-jerk reaction. You know, it lasted all afternoon. It seems to be lasting all day today. I still think this is going to reverse and we're going to get a little bit of a rally. But, you know, if tomorrow is another red day, I guess I'll be surprised and maybe I'll be on the wrong side of this one. Okay, so this is in Jackson Hole. He opened the speech by saying this.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy.
Okay, so that's the opening of his speech. He says right there, you know, in the past I've talked about many things. Today, I am here to talk about inflation. And this is what Jerome Powell has been saying every chance he gets. So again, this was 3 weeks ago. This is not the Fed saying something yesterday. This was 3 weeks ago in the Jackson Hole Convention. So next he said this.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
He was quite specific that he's going to continue to raise rates, but that this is what has to be done to bring down inflation. So he intentionally made a 10-minute speech and didn't talk about anything else at all except this, to make it crystal clear to everybody that he was going to continue to raise rates until the job was done, until his mandate was reached, which was to get inflation moving back in the right direction towards its target goal of 2%. So I'm going to show you the videos that I did. Just going to run through some numbers very quickly to show you why I think the Fed did exactly what we thought they were going to do. It's exactly what I said that they were going to do in the video that I made before the meeting. And again, I can't tell the future. This is what Jerome Powell's been screaming at the top of his lungs for the last several months. The August CPI numbers were a big disappointment, and you know, it crushed the market. And it really coincided with what Jerome Powell's been saying, that we don't have a handle on inflation the way everybody thinks we do, and we're going to need to do a lot more to get it there. So this information right here is the compilation of all the members of the Fed. So you can see back in June, they thought in 2022 they were going to have to raise rates as high as 3.4%. So that's the consensus average. And then they thought in 2023 they'd have to go as high as 3.8%. So they did raise both of those significantly. However, this was 100% priced in, and what they raised them to, in my opinion, and I'm going to show you the charts, it almost exactly matched what the market was expecting. So the federal funds rate, they now say in the year 2022 is going to have to get up to 4.4%. If we look at the probability table, you'll see that they're saying 4.4% by the end of the year. This is for the December Fed meeting. So we already had 67% of the people saying 4.25 to 4.5%. We have just under 30% of the people saying 4 to 4.25. Now this is after the meeting, but let's look because this did not change much. If we go back 1 week, you're going to see there was only 7% of the people that disagreed with that a week ago. That is now down to 0%. So this changed very few minds. This was very close to on target with what the market was expecting. 7% of the people got a little bit of a surprise. That's a little bit of a surprise to the downside, but mostly this is exactly what we priced in. Then if we look at what they said they're going to do in the year 2023, they said they're going to need to get up to 4.6. Okay, so this is the probability table for the March meeting. So that's March of 2023. You're going to see the Fed said by the end of 2023, at some point in 2023, they were going to have to reach a high of 4.6%. As of March of 2023, we already have priced in, here's 4.5 to 4.75. So that's the range they think they're going to be in. 47% of the people are already there. 38% of the people actually think it's going to be worse than that. And again, if we go back a week, you'll see this was basically the same sentiment. In my video before the Fed meeting, I basically said, listen, they max out at about 5%. Anything over 5, 5.25, 5.5, they can only do for a short period of time, and that would be drastic measures. So I want to show you a chart of what the Fed themselves thinks. So this is the underlying data for where the numbers came from that we just looked at. Each one of these dots represents a member of the Federal Reserve. So you can see about half of these dots are between 4 and 4.25. The other half, actually a little bit more, think it's going to be between 4.25 and 4.5%. So that's the 4.4% average. And I think this absolutely, like we looked at, the market already had this completely priced in. If we go to the following year, 2023, I think this is what surprised the little people, but I'm going to tell you why I don't think it's a surprise. The first thing you can see is there's not one single Fed member that thinks they're going to have to raise rates above 5% at any time going forward. So that is very consistent with what we talked about in the video. You'll see in 2023, all of a sudden you've got basically this split 3 ways. So this all averaged out to the 4.6%, 4.75 to 5%. Is where I thought we would be. I think it's where most people thought we would be probably by the end of this year. So the biggest difference is this maybe got pushed off a quarter. People thought we would get there sooner. Ultimately, I do think we will start getting rates lowered in the year 2023. So a lot of people interpreted this report to think that there's not going to be any lowering of rates in the entire year of 2023. But I don't think that's what they're saying here at all. I think they're just saying that it's going to get a little bit worse before it gets better in 2023, but we're going to peak sometime maybe in the first quarter of 2023, and then they're going to have to start easing for the rest of the year, in my opinion. So I think that's consistent with what this report says. You guys let me know if you agree with that, if this met your expectations. I mean, I'm expecting people to digest this and get over it over the next couple of days, but we will see. So we're going to see if we get this relief rally. And again, I'm not calling for a bottom and a bull run. I just thought we would get a little bit of a relief rally after the Fed said what really I think we all knew they were going to say. So let me know if you think I'm wrong and what you think. If you made it this far, thanks so much for watching. Please remember to subscribe to the channel and smash the like button. Thanks again. We'll see you in the next video.